The world's heavy hitters are voting with their wallets, and the verdict is in: Europe's dimming economic prospects outshine America's resilient expansion. In a seismic shift that's upending long-standing assumptions, elite investors are ditching U.S. Treasuries in favor of their European counterparts, betting that cooler inflation across the Atlantic will compel the European Central Bank to slash rates before the Federal Reserve blinks. The numbers tell the story. The gap between benchmark 10-year German and U.S. borrowing costs has swelled to a staggering 2 percentage points, practically uncharted territory last seen in the tumultuous days of November. Titans like Pimco, JPMorgan Asset Management and Rowe Price are leading the charge, rapidly ramping up their European debt holdings at the expense of good old Uncle Sam's IOUs. The path for rate cuts in Europe is far clearer than here at home, Bob Michel of JPMorgan Asset Management remarked with a sage nod. The erudite fixed-income guru has been moving in the direction of gobbling up more European bonds, citing the dearth of any economic reasons for the Fed to ease off the brakes. Indeed, a great economic bifurcation is afoot. While the European locomotive sputters, softening inflation and a faltering economy bolstering expectations for multiple ECB rate slashes by year's end, the American juggernaut rumbles on, seeming to render imminent Fed rate cuts increasingly improbable. A stark role reversal from just months ago. Naturally, the dramatic repricing has roiled global bond markets. Though yields on both continents have climbed as investors rethink their rate cut wagers, the moves have been far starker stateside. The symbolic 10-year Treasury yield has skyrocketed 0.5 percentage points to 4.4%, while the German Bund equivalent rose a more muted 0.3 points to 2.4%. For institutional behemoths like Pimco and Rowe Price, with billions upon billions in assets to allocate, the investment thesis is clear: hitch a ride on the European rate-cutting wagon. We prefer to be underweight in U.S. Treasuries in favor of Eurozone bonds, including bunds, asserted Rowe's Quinton Fitzsimmons, citing his high conviction in a June ECB move even as domestic strength forces Fed doves to backpedal. Pimco's perspicacious Andrew Balls echoed the rationale, favoring European and British debt this year as more evidence of inflation correcting emerges across the old continent. The Newport Beach firm has already slashed its Fed rate cut forecast from 3 to a mere pair of quarter-point trims, an outlook solidified by March's blockbuster employment data. The schism between European and American rate trajectories stems from a profound economic decoupling. While the latest U.S. inflation readings have doggedly overshot expectations, Eurozone price pressures are finally losing air, sliding to 2.4% last month and kindling hopes for imminent ECB action. In stark contrast, the Federal Reserve's own forecast envisions its preferred inflation gauge, the core PCE index, decelerating only modestly this year to 2.6%, still well above the 2% target. America's relatively insulated, government-fueled economic boom continues apace, clocking sturdy 2.1% growth projections versus a feeble 0.6% European estimate. Growth in the U.S. has proven far more resilient than across the Atlantic, mused BlackRock's David Rogel. He attributed this divergence to America's relatively closed economy and aggressive fiscal impulse versus Europe's greater trade sensitivity and tighter purse strings. Rogel's quip hits the mark. While Washington is expected to run a Gulf-sized 8.1% budget deficit this year, Germany's gap is projected at a comparatively minuscule 1.4% of GDP. Yet for all their conviction, the bond barons risk getting ahead of themselves. Some oracles warn that excessive ECB policy divergence from the Fed risks catapulting the euro into freefall, potentially rekindling inflation and derailing the very rate cuts the market is banking on. There can only be so much divergence before provoking a massive currency meltdown, cautioned Barclays' Mike Pond. If the Fed remains resolute, it might ultimately scupper the ECB's dovish ambitions. Only time will tell if the great bond reallocation augurs prescient foresight or mere folly. But one thing is certain, 2023 has ushered in a sea change in how investors are positioning for the next phase of the inflation cycle. While the previous era saw lockstep central bank policy, the emerging regime could splinter old allegiances, pitting nation against nation in the high-stakes battle to revive economic stability. For the titans pulling the strings, it's a generational wager with billions on the line. And they're voting with their feet, abandoning the former havens for pastures anew. In the ever-evolving bond universe, the old order has been upended. A new celestial dance is afoot, and only the shrewdest investors will divine its stride.